Hello and welcome to this lecture on the law of insurance. In this lecture, we are going to understand what is insurance. We're also going to be looking at the elements of an insurance contract. We'll also be able to look at something very, very important in the insurance conversation, what we call the principles of insurance. We are also going to understand how we terminate, or how does an insurance engagement or a contract come to an end. So welcome to this session. It is important first to note the reason why we are studying the law of insurance. Number one, we want to understand issues around protection against risks. We also want to ensure that there is fairness and regulations around the insurance space. And the law of insurance is also very, very essential and critical for those that are professionals in the insurance sector, those that are professionals in the banking sector, those that are also doing business. And we also study the law of insurance because we need to understand the rights and duties under the insurance contract. So this is a very important law to be able to understand because we need it on our day-to-day activities. When we talk about insurance, we are noting that it is a contract in which a person or a business receives financial protection from an insurance company. And this protection happens when you have protected against specific risks or losses. Of course, for you to be paid, that's why we are saying in case of loss, that's why we are noting that in our point number 2, then you, the person who has been insured, you now pay what we call a regular amount. We call that a premium. And then this particular premium is going to cover various events. It could be accidents, it could be illnesses, and other forms of damages. So once these events occur, or once these risks occur, and you have been paying your premiums, then the insurer comes in to pay compensation. And the main reason of insurance, a very, very important point, we are noting that is to reduce the financial impact of unexpected events. You have suffered loss due to unexpected fire outbreak. You have suffered loss due to an accident. The main purpose of an insurance is to bring you back to your original position. So very, very importantly, we look at the essentials of an insurance contract. When we talk about essentials of an insurance contract, we borrow them directly from what we call essentials of a valid contract in our discussions around the law of contract. So number 1, there needs to be an offer and acceptance. One party usually makes the offer, and that party is usually the applicant, and the other party, who is the insurer, accepts it, and by doing so, it becomes an insurance contract. We usually also say that an offer is a promise to do something, and then the one who accepts will now get into a binding insurance engagement. This is very, very important, essential number 1. Number 2, we also note that it has to be a contract, and we usually say a contract is a binding relationship between two parties, and these two parties are what you have just mentioned above. In the context of an insurance, you, the applicant to be insured, and the insurer, which is the insurance company. Then number 3, very, very importantly, is also the insured pays premium. So when we are talking about consideration, we usually say, even as we discuss the law of contract in other contexts, that consideration is something of value. And something of value in the context of our case here as an insurance company, then it is the regular premiums that you pay. And once you pay consideration, then in case of loss, the insurer promises that they are going to compensate you for loss. And then number 4 is what we call capacity to contract. Both parties must be legally capable of entering into the insurance contract. That means they need to be of sound mind. They need to be of a legal age. That simply means they are not minors. We can also bring another point still on the examples there to say that they should not be bankrupt. Or in the case of a company, it needs not to be have been declared insolvent. And lastly, the final essential of an insurance contract is that it has to have a legal purpose. The contract must be for a lawful reason and not involve illegal activities. So illegal activities are those activities that the law does not allow within a particular jurisdiction. For example, you cannot be able to seek to insure a company that is doing activities around the poaching, allowed around illegal trade of elephant body parts. That is not allowed. We are going to be interacting with a number of terms in this session. Term number 1 is what we call insurance. We have mentioned it again. It's all about providing protection against events that might happen, such as accidents, fire, or theft. And then we also have something we call assurance. What is the difference between insurance and assurance? When we talk about assurance in the insurance conversation or in the law of insurance, it is where coverage is on certain events. Those events that are sure one day are going to happen. Sometimes when we do insurance, when we cover fire, accident, theft, if that policy is for 1 year, the year can come to an end and that accident or fire has not happened. So in case of what we call assurance, there is certainty that at some point it's going to happen. For example, death. So where do we practice assurance? For example, is under the life assurance, where people are guaranteed payout to because a death has occurred. That payout definitely goes to their family members, for instance. And then we have a very, very important document we call the policy. And we know that this is the legal contract between an insurance company and the insurer. So it is an important document that if you enter into an insurance contract, you need to have this document. It is an evidence. Remember, we have there is emphasis on writing some of these engagements. You cannot just have a verbal agreement on them, because in case of anything happens and the insurer is not willing to pay, then you can seek legal redress with the evidence of that there was a policy document. Now, the final statement under the policy document is to tell us what does a policy document contain, or what are the contents. So we are noting the first one is what we call the terms and conditions under which the insurer will provide financial protection or reimbursement for specific losses, damages, or liabilities. So underline terms and conditions. What is the policy about? It is a legal document, a contractual document that in it we are able to find the terms and conditions of the insurance contract. Other terms also very key in this discussion is what we call surrender value. And we note that it is the amount of money a policyholder receives from insurance company if they decide to terminate. That is where we are borrowing the word surrender. Yeah, so if along the way you are paying premiums, for example, for 1 year, and then something happens, maybe you lose your job and you are unable to continue paying your premium, then it means that contractual relationship cannot continue to exist. So the insurance company is going to come back and and pay you what they call a surrender value. It is an amount that you are going to receive because you have midway terminated the contract. Then we have what we call a paid up policy. We know that is a life insurance policy in which the policyholder stops paying future premiums, but the policy remains in force with a reduced sum assured. So a paid up policy, you're going to find the person who is insured, they pay a bigger amount. Let's say I was supposed to pay a premium for a whole year. Then I decide, rather than me paying every month, let me just pay a full amount. Yeah, that means the insurance contract will continue to be running. Now we have what we call the types of insurance. We have what we call uh, life insurance businesses, general insurance businesses. What happens in life insurance businesses? These kind of businesses are going to provide financial protection to the policyholders, family, or dependents in case of the insured death. So, in case of the insured death and somebody who was in a life insurance business, the family and dependents are going to benefit. That's why when you go to read those policy documents, you're going to find spaces where you are supposed, for example, to fill what we call the next of kin. So that in case of anything and it was a life insurance business, your dependents, your family are able to be compensated. Under life insurance, we have an extended classification under it. For example, what we call term life insurance. Now, the reason we are calling it term life insurance is because you choose to be insured for a specific time. 10, 20 years is an example. Now, we are also noting very important under the time life insurance, no payout if the insured survives the term. Now, this is an interesting kind of an insurance. Yeah, that if you insure about time life insurance, let's say 10 years or 20 years, and the death does not occur within that time limit, yeah, you are likely not to be paid, or you will not be paid any amount if those years are complete and the death has not occurred. That's an interesting one. And then we have whole life insurance. This kind of an insurance covers the insured for their entire life. And then, of course, benefit is guaranteed upon death. We have noted there that that benefit goes to the family members or next of kin. And then still under life insurance, we have what we call endowment policies. So these ones will combine an aspect of insurance and also aspects of savings. And then at some point, when we talk about maturity in a policy, maturity is when the years that you had committed yourself maybe to doing the savings, uh, once those years come to an end, for example, 10 years, then a lump sum amount is paid on death or policy maturity. Yes, and finally is a pension stroke annuity plan. And we are noting that it helps build a retirement corpus, regular income post-retirement. So this is for retirees. Someone, as they continue with their day-to-day activities, they can enter into a pension or an annuity plan, and then they can be able to be paid once the retirement takes effect. And then after the retirement, you can still enjoy regular income from your insurance. Now, under the general insurance business, we're noting that it covers financial losses due to events other than death, events around accidents, around theft, natural disasters. So a further classification around the general insurance is, for example, the health insurance. It covers hospitalization and medical expenses. Um, That is a common one in various jurisdictions and countries, the health insurance. Then we also have the motor vehicle insurance. We are noting it is mandatory for all vehicles. That is also another very common one, and it is an annual payment that you make. So if an accident occurs within the year, then the insurance company is going to verify the nature of the accident and see if it qualifies for reimbursement or for compensation. And then you are compensated. We have situations where the car is written off. Yeah. So the insurance also compensates you. It may be because of the aspect of undergoing wear and tear. It may not be the exact amount you bought the car, but maybe it can help you be able to plan yourself from the amount to be able to buy another car. Then we have fire insurance. We are noting that it covers losses due to fire and related perils. And nowadays we have challenges around fire. It could be electricity faults. It could be we are selling flammable items and so on and so forth. So it is also very, very important to insure yourself against fire. We are going to see a very important principle that even when you have done insurance of whatever nature, you have to take precaution that it doesn't happen. That is what we call the principle of mitigation of loss. So just because I have insured my house against fire, then it doesn't mean that I just have everything around the wiring not done very correct. Yeah, so insurance companies expect us, even though we have taken insurance, we also have to exercise the duty of reasonable care. Yeah, it is not that you have now insured your motor vehicle, you drive recklessly around in the name that you are going to be paid. It doesn't work that way in insurance. And finally is the marine insurance. We are noting that it covers loss or damage to ships and cargo in transit. Under the marine insurance types, we have also what we call a voyage policy. It covers a specific journey or voyage. That could be maybe the voyage is, or the ship is moving from Mumbai to London, so it is covered for that particular journey. Then we have what we call time policy. It covers a vessel for a specific period. You could cover, when you're talking about a vessel, here is what we have just given an example on the previous slide. A ship, it can be insured for 6 months to 1 year. Yeah, regardless of the number of journeys that it makes. But those journeys should be within the stated period in the policy. Then we have what we call the floating policy. It covers multiple shipments under one policy, up to a specified amount. So this is a combination of, it could be a combination of even the two above that we have just mentioned. And finally, we have port risk policy. It covers a ship while it is stationed in a port, and not during voyage. Voyage, not during the transportation time. Just by the virtue of the ship being stationed at the port, then it is covered. Remember, there are issues that can happen, accidents, fire can break out, and we lose the ship. So by the virtue of it stationed in the port, it doesn't mean that you do not insure it. We are getting into a very critical decision on what we call the principle of insurance, or the principles of insurance. Principle number one is what we refer to as utmost good faith. Another name that we refer to this principle is what we call uberimae fidei. And we are saying in this kind of a principle, then, it is a requirement that both parties, remember we have said the both parties in the conversation of an insurance is the insurer and the insured. We are noting that they must disclose all the material facts, give information as it is, Remember, the consequences of going against these principles is that you may lose your compensation. Yeah, that's why even for health insurance, insurance companies are going to ask for a medical report, an examination. And you also realize in the case of elderly people, not very many insured companies are willing to insure them because the risk is a bit higher. But it is important that as you come into any agreement, let the insured, let the insurer give all the important uh, information that is needed. So that now you don't go and claim and they tell you, oh, you did not tell us you had this disease when we were insuring you. The second one is what we refer to as indemnity. We know that insurance aims to restore the insured to their original position, not to allow profit from a loss. So it is all about returning you to your original position. That is very, very important. So indemnity principle allows you to be compensated. Now, we have a case, a famous case under indemnity, what we call Basford versus Royal Insurance Company. And what happened in this case is that Basford had insured his life with the defendant company. The defendant company in this context is Royal Insurance Company. Yeah? And then what happened to Basford? He shot himself intending that the insurance money should be paid to his estate. But unfortunately, the court ruled that the estate of Basford could not recover the insured sum because his act of shooting himself, suicide, was aimed to benefit his estate out of his crime. So you cannot do a crime. Basford was expecting that if he shoots himself and the family goes to make a claim of his insurance, that they are going to be paid. But insurance conversations, we don't do such kind of acts. You don't, just like I've said, because you have insured your car, then you cannot drive around recklessly so that in case of an accident, you are compensated. And we're also saying it is not a profit, it is not a profiteering kind of a contract. It is to bring you back to your original possession, to compensate you through what we call the principle of indemnity. Then the third one is what we refer to as mitigation of loss. And we are saying that the insured must take reasonable steps to minimize loss or damage even after the event starts. That is the particular very specific example I've talked about, insurance against fire. By the virtue that you have insured yourself against fire, then it doesn't mean that you are reckless in terms of your wiring, you are using substandard materials. Actually, most insurance companies are going to even tell you, put in place fire safety measures, put in place fire alarms, put in place fire extinguishers, so that that risk does not happen. So the emphasis of this principle is do something to prevent whatever you have insured. Yeah. It's just like somebody who has insured their car and they do not take it to service. It's going to be very unfortunate once an accident occurs for that car. Yeah, things may not go as that person is planning, that compensation will be automatic. Another very important principle is what we refer to as the principle of subrogation, and we are noting that after compensation is paid, the insurer gets the legal right to recover the, the loss from a third party. That is, if someone else caused it. Now, the principle of subrogation is very, very important. Sometimes an accident occurs and it was caused by a third party. Now, what happens? The person who was insured will still go to the insurance company to claim for compensation. But the principle of subrogation allows the insurance company now to go for the third party. They also want to exercise indemnity and recover some loss from the third party. Now, number 5 is what we refer to as risk must attach. We are noting that an insurance contract is not valid or enforceable unless the actual risk begins. So you cannot claim for what we do not have as evidence. We need to have an evidence that I insured my business for fire and fire has happened. So must attach is a saying that what you had insured must happen. That is what we mean by risk must attach. That also simply means you cannot go and just make a claim and you will be paid. That is why insurance companies are going to come and verify the information that you have given them. If it is a car accident, they want to physically see what is the damage of the car, and they have assessors and valuers who are supposed to do that particular work. And then we have the principle of contribution. We note that when a person has multiple policies covering the same risk, each insurer pays a proportion of the loss. This prevents overcompensation. Remember what you have said in indemnity. Insurance policies, insurance engagements are not to make profit. So even if you take 2 policies, there is the insurance companies are going to come in and each is going to partly pay a certain amount because of what you have just said. It is not a profiteering activity or contract. So contribution means each insurance company to contribute a certain percentage to be able to compensate you. Now we have what we call reinsurance, and we know that it is a financial arrangement where insurance companies transfer part of its risks to another insurance company. So the insurance companies, it's very interesting that they also insure themselves. Remember, there are those situations where the claims could be extremely expensive. Yes, the claims could be extremely very expensive. So they also insure themselves to cushion themselves from the situation where a claim could be done that could even leave the company insolvent. So why do we do reinsurance? Number 1, it is an act of managing the risk. It reduces risk exposure to large losses. And then also we also do reinsurance because we expect stability. It is going to help insurance maintain financial strength after disasters. And then also capacity. Another reason why we do reinsurance is capacity. And that simply means it allows insurance to underwrite more and larger policies. So that is like saying when we do reinsurance, we are also giving the company that is also insuring itself more strength, more capacity. That even if they find an insurance engagement that is of high value in terms of premiums, they can still enter into that contract, knowing very well if the risk occurs, that insurance that they have placed under reinsurance in another company can help them remain in the same financial position and not get into a loss because they have paid a huge compensation amount. The other one is solvency protection. It prevents bankruptcy from large claims, or it prevents what we call insolvency of companies. And finally is what we call profit smoothing. It spreads risks over time. So it is also a way of spreading your risk, that you're not putting your eggs in one basket. And then also we have in insurance what we refer to as double insurance. It occurs when the same person or property is insured under 2 or more policies for the same risk and period with the same insurable interest. So it is also important to disclose this double insurance. If you have done 2 insurances, it is also important to disclose as you are entering into the contractual agreement. That's why we are noting it is very, very important. If it is not disclosed, then it may be considered a breach of good faith, or a breach of what we have just said, the utmost good faith principle. Now, how does insurance contracts come to an end? That is our discussion on termination. Number one is mutual consent between parties. So we have situations where both parties, remember the parties we have said is the insurer and the insured, are going to agree to terminate the contract. And then also we have expiry of the policy term. For example, if you take a motor vehicle insurance for 1 year, if you don't feel satisfied at the end of the 1 year, you can be able to look for another insurance provider because the term has come to an end. It is an annual payment. It is not that you are under duress or you are being forced to remain with that insurance company forever. They have to meet your obligations and demands. Something could happen, maybe an accident, and these people do not treat you as they should, or you don't feel they are putting their effort for you to be compensated. You can be able to change at the expiry of the policy term. Another very, very important is failure to pay premiums. Remember, we have said essential elements of an insurance contract. Consideration has to be there. And we said consideration is the premiums that you pay. So if you do not pay these premiums, you can be able to, the engagement can come to an end. And then we have insolvency of the insurer. That is the company. The company can be declared insolvent. So it may not continue to run. And finally is when a breach of an insurance contract happens. So thank you very much. We have come to the end of this session.